All right, everyone. Thanks so much for coming. Thanks, Josh. Thanks for introducing me. So basically today we're going to talk about the hidden costs of trading and how Krypton is solving those in a unique way. Just to summarize real quick, because a little bit over time already, so there are basically two flavors in which hidden costs come in finance. And so this concerns both TradFi and DeFi. The first flavor is front running. The second one is adverse selection. Front running, everyone understands in DeFi. It's basically toxic traders buying out block space via flashbots, reordering transactions in a block, and exploiting other traders. Adverse selection is something that gives rise to impermanent loss. And basically, it is an informed trader monetizing an information advantage against the market maker or against the liquidity provider. And so market makers know that this exists, this cost exists. It's just a cost of doing business. But they need to recover this cost from all of us, which means they're going to set a bid-ask spread. I will not go into detail about these costs. I will mostly focus on the demo. If you would like to know more about adverse selection and the costs and how they arise, please just watch my other talk that I gave here in Barcelona a few months ago at the Avalanche Summit. So some might think, maybe the problem is the automated market maker that's basically used in DeFi, and that's part of the problem. But another part of the problem is the way that blockchains come to consensus, which is basically giving miners and validators the privilege to decide what the order is that transactions go into a block, and that has value in existing exchange mechanisms. Now, if you look at TradFi, where there is no blockchain, right, where there is no miner extractable value, there are these massive hidden costs in trading. So all of us together, we are losing tens of billions of dollars every single year. And this cost is only increased by trading on blockchains. Now, if we want TradFi, if we want institutions to move over to blockchains, if we want DeFi to be the global standard of trading, then we need to find a way around those costs. And that's essentially what we're doing. So let me just briefly explain how these costs arise. So if you think about existing exchange mechanisms, think about AMMs or think about central limit order books. Whenever an aggressive order hits a resting order in an order book, value is exchanged at a single instant. According to some price and time priority rule that defines the matching engine, the maximum quantity that can be transferred is being transferred in a single instant, right? So finite value, number of tokens, shares of stock, or dollar value is transferred in an infinitesimally small amount of time. That makes for infinite trading speed. So if you look at the history of trading speeds, in any existing exchange, it's either 0 or infinite. That means if you are able to just come a little bit before everyone else, you're able to take advantage of the entire opportunity, whatever that opportunity is, if it's front running or if it's adverse selection. And that's what creates those costs. So if you think about that, if the infinite trading speed is really the problem, then why don't we just not do that? And what we do on Krypton is we transfer value at finite trading speeds in continuous flows over time based on a market equilibrium. Demand curve equals supply curve. And so this very nicely gets rid of both front running and adverse selection. And so what I'm going to do now is I'll just briefly show you what Krypton looks like right now. So we are here in what we call the Pro dashboard. So the Pro dashboard is the user interface that has all the bells and whistles. It allows you to tune every parameter, and it allows you to see the consequences of your choices. So this is a novel way of trading. No one has ever traded that way before, and our research team has made sure that you have assisted technology to unlock the potential of Krypton. And the ways we're doing this is we give you good defaults on all kinds of values, such as trading speed, and we show you with a predictive Monte Carlo simulation that's run in the web browser on the GPU. We show you the consequences of what you're likely going to get. And so let's just get started. So we're here in this wrapped Bitcoin USDC market. And if you look at the center here, you see the order book. Now, this is not a traditional order book. This is a continuous flow order book. The green curve is the demand curve, and the red curve is the supply curve. What you see on the horizontal axis is price, and the vertical axis is trading speed. So let's just click on the buy button here and try to buy 1 Bitcoin. What now happens, we predict for you what the order will look like that you're constructing at the moment before submitting it in relation to everything else in the market. So what you're seeing, this green line, that's a visualization of the parameters of your proposed order. Right now, there are basically 3 parameters we have to care about. It's the max trading speed, and then an upper and a lower limit price. The max trading speed at the moment is about 1/10 of a Bitcoin per second. And so that's represented visually here as the height of this green line, the difference of this green line with the horizontal axis. Then if the price on the exchange remains below the lower limit price for a buy order, you trade at the maximum speed. If the price increases above the lower limit price, your trade starts slowing down. And if it goes above the upper limit price, you just stop trading completely. So this kind of very nicely speeds up trading if the price is favorable and slows down trading if the price moves against you. That's not the main part of this. If you look at this, the proposed intersection would be somewhere here. Now, if you want to trade faster, perhaps because you're a toxic trader, you have some short-lived information, then you would automatically move the price against you. So I can just enter a higher trading speed, and you would see that it intersects at a higher price. So that's already not good for you, right? If you're trying to adversely select the market maker. But there's more. All of the market participants will see that the price just jumped and the trading speed jumped. So that is a dead giveaway that someone is trying to monetize a short-lived signal. Why would anyone need to trade at a very high speed and seemingly at a very unfavorable price? So because this is a flow trading system, the moment this information is transmitted to the market, the damage is just starting to get done. If market makers and other participants can react, then they can basically stop the bleeding before it has started. Now, because adverse selection, losses to toxic traders, are the fundamental cost of a market maker, the hidden cost that we can avoid. In a competitive equilibrium where there are multiple market makers, they can simply charge a much, much lower spread because they have fewer losses to recover from the toxic traders, which makes it better for all of us. Now, what we're going to do here is let's just experiment a little bit with those parameters. So let's just say, instead of wanting to buy 1 Bitcoin, where we have like 0.1 Bitcoin per second, so basically every 10 seconds we get a Bitcoin at this maximum trading speed, let's just enter a quantity of 10. And so what we see is that Krypton has now recommended that we trade at a higher speed. The trade-off basically is that if you trade fast, then you have a higher certain price impact. But if you trade slow, there is more risk that the price is going to slip away from the price where you want to buy at. So you may have higher implementation shortfall. It can also move in your favor, right? That's just risk. And so what we do is we predict for you a trading cost, which right now for 10 Bitcoin is around 13 basis points. That's just a point estimate. In order to characterize uncertainty, we show you here in the lower right corner a probability density function of the possible outcomes that you could expect. And then you can dial it in kind of however you want. So let's just add another 0. Let's say we want to buy 100 Bitcoin. So it's predicted to probably go through in 38 minutes. Parameters are chosen such that we're likely going to get our quantity, right? The price will not slip outside of our range. And so the total value of this trade would be $2.8 million. Because we do not want to be here all day, and I have like 2 minutes left, I'm simply going to go down to a quantity of 10, keep the trading speed essentially where it is. Maybe I'll dial in the, let's dial in the parameters a little bit. Let's see if you slow down at 10 basis points. Yeah, that works. And then maybe stop the trading if it's 20 basis points above where you want it to be. Let's place the order. Okay, so MetaMask, our old friend, confirm the trade. Now it takes a while until this is mined on the blockchain. So the order has now appeared, as you see. The order book is changed, and we can just see at the order executing. So what's basically summarized here is what the order book looks like. Then we show you an updated simulation of what you're likely going to get. It shows you that the order is now about 30% filled. It's expected to fill, pretty well, and that goes up, so that's good. We didn't make a mistake there. and then you see what realized price you got, actually what the expected price is, et cetera, et cetera. And so while that's going on, let me just move over to the simple dashboard. And so fundamentally speaking, the nice thing about Krypton is that you don't need to understand all that if you don't like to. If you use a simple dashboard, you don't need a PhD. You can just tell Krypton what token you want to give and what token you want to get. So let's just do that. Let's say we want to now trade from wrap Bitcoin to USDC, which is just selling the 10 Bitcoin we just bought. And you see that on average, we're going to get $282,000 for that, for these 10 Bitcoin. This also comes out of the same Monte Carlo simulation. The difference is that we don't show you all these other things. If you wanted, you could make this trade right now. But let's see if we can dial in the parameters a little bit. So the expected fill rate is great, it's high. Let's see what happens if we reduce the trading speed. So since we're selling, a high price is good for us, right? So if I reduce the trading speed, the number should essentially go up, which it does, wonderful. And then let's reduce the slippage a little bit. Let's go to maybe 10 basis points. You see the fill rate is still pretty high, so let's just also reduce the upper limit price. Yeah, it's good. So I'm fine with just making this trade. Let's confirm. And then we'll just see how this trade fills, how it implements over time, at what speed, what the expected time to completion is, how price and trading speed relate to each other. So for a sell order, that's kind of the opposite situation of what you would have for an advanced limit buy order. If the price is high, then you sell fast. If the price gets lower, you sell more slowly. And that's basically what's shown in these two half circles, right? So the green one corresponds to the trading speed. The blue one corresponds to the price. The expected fill rate, hovers around close to 100%. Here we see the trade is now implemented about halfway through, and the expected time to completion is 37 seconds. So it kind of seems to all work out. So let me just close. So if that seems interesting to you, then please feel free to sign up for the early access of our beta. It's coming in a while. We're still heavily at work on it. You can either scan the QR code or you can just go to the website. Thank you so much, guys.